Hello, active traders, and welcome to ETF Trading Success Strategies. I'm Ken Calhoun, and I'm joined by my longtime colleague, Toni Turner. Toni, it's great to have you with us here today.
Thank you, Ken. It's great to be here.
Toni will do the first half hour, and then I'll do the second half hour. As always, all information is for educational use only. We're not making advice or recommendations about what to buy, sell, or hold, and by watching this, agree to not make actual trades. So fasten your seatbelts. We've got an exciting session lined up for you. Let me introduce Toni. Toni Turner is the president of TrendStar Trading Group. She's an accomplished technical analyst as well as a popular educator and sought-after speaker in the financial arena. I've learned a lot from Toni personally too. She's the sharpest person in the world I know for ETFs. Plus, I learned how to use the ARMS index, the trend in her Beginner's Guide to Day Trading Online, which is one of many books that she's the author of that are best-selling books available for active traders. Toni's appeared in CNBC, CNN, NBC, and Fox Business News. She speaks at conferences across the country, including college campuses, traders expos, and money shows. So great to see you here, Toni, and wanted to tell everybody you're in for a real treat. So let's go ahead and get ready. I will go ahead and turn it over to Toni, and we'll get underway.
Thank you, Ken. Okay, just give me 1 second here, everybody, to get set up, and I will get this in shape for our program. Okay, Ken, I'm going to assume that you can and everyone else can see my screen, my PowerPoint. Is that correct?
Yeah, it looks perfect.
Okay, great. Thank you. Okay, we've got a lot to cover here today between Ken and myself. So let's get started. Again, as Ken told you and his title slide said, today we're talking about ETF trading success strategies. I am Toni Turner. If you need to reach me, my website is toniturner.com. And of course, you can send an email with any questions you have to info@toniturner.com. Tina, our Director of Operations, will get those emails and make sure they go to all the right places and your questions are answered. So today we have, when Ken so kindly invited me to speak at this webinar, we talked about exchange traded funds. And as you know, that is one of the biggest it has become one of the biggest subjects in the stock market, and Ken and I could spend the next 3 weeks standing in front of you talking about exchange traded funds, and we probably wouldn't get done then. So we're going to go over, I had to pick a section today. I wanted to pick an area of ETFs that I thought would give you all the greatest advantage to work with, and I'm talking about sectors, the sector ETFs, for the next few minutes. And maybe give you an idea of how to follow the money, because that's really what you need to know with these. So there are 10 sectors represented in the S&P 500 index, and sectors they cover the broad berth of 10 diverse commercial groups, and these groups are what drive our U.S. economy, and we probably could say they drive the economy of most industrialized nations. Now, each sector contains individual industry groups, and that's something that I think people get kind of confused with. I hear a lot of people on, excuse me, talking heads on CNBC and other networks, and they're always saying this sector and that sector, which like the telecom sector. Well, there isn't any telecom sector. Telecom's an industry group. It may be someday, but telecom is an industry group within the technology sector. And so, or they'll say the biotechnology sector. There's no such thing. It's the industry group under the umbrella of healthcare. If you can kind of get this into your head, it helps you recognize them. And so we're going to talk about that today, and I actually have a page or 2 pages on my website that can really help you, and I'll give you those pages. They're free. You just go there and check them out. It can really help you out with sectors and industry groups and the ETFs that are in them, so you'll have a good watch list of which ones to trade. Now, knowing again how the money flows through sectors let's say at what times in the market really helps you minimize risk, and it helps you maybe go to a sector or an industry group that everybody else wasn't looking at. Maybe you get in first and really make some profits from it. So let's talk a little bit about how to follow the money. And we're going to talk a little bit about here about the 10, before we get into the charts, we're going to talk about the 10 sectors within the S&P 500, and I'll tell you a few of their industry groups, but again, I'm going to tell you where all that information is on my website. So first of all, when we're going to look at a chart that shows you that the markets of industrialized nations move in cycles. Markets don't move straight up forever. You may think the market we're in right now is going to move up forever. And I've been in this business. Ken and I have been in it for many, many years. I don't even want to admit how many years I've been doing this. And I can tell you right now that markets don't go straight up forever. It's tons of fun when they do. But, and it's easier to make money when they do what they've been doing for the last, 9 and almost 10 years. But when the going gets tough, that's what separates the professional traders like you and I and the ones that haven't paid attention. So as we're looking at cycles, and we're going to look at cycles on a chart in a minute of the S&P 500, we talk about cyclical sectors. Cyclical means that when the economy is doing well, as it finally is doing well since that big dip in 2000 and down at 2008 and 9, well, it was more than a dip, it was actually a pretty bad bear market. When things are going well, there's a group of sectors that usually do really well, and it makes perfect sense. Like we're talking here, these are the 10 ETFs in the select sector spiders, and materials always does do materials ETF, and it's the XLB in this case. Materials do well, as you can imagine, when the market's moving up and the economy is thriving. Materials like Dow DuPont, like Monsanto, like Praxair, those kinds of stocks tend to do well in an economy that's rising, obviously, because manufacturers are using those products and need them. So they're sold quite well. Consumer discretionary, that's the XLY. Consumer discretionary are stocks like that you don't have to have, but you can have them if you want, and that would be like McDonald's. You choose to go out for dinner instead of eating at home. It would be Disney, it would be Comcast, it would be Tiffany's, it would be Carnival Cruise Lines, those kinds of things that are fun. And of course the like all of the what am I going to say, the the word's not coming to my mind here, the gaming stocks, like Wynn, the hotel stocks, the gambling stocks, I want to say. When we get into energy, of course, we know that's pretty easy. The top stocks in this, and it has to do with Exxon, Chevron, Schlumberger. So this would be oil, natural gas, and oil, natural gas, and solar, and wind. All of those companies would be in the energy ETF. Of course, we need energy for a thriving economy to build things. And so it's obvious that energy would go up during this period of time when the economy cuts back and the manufacturing slows down and so forth, then energy isn't needed as much. Now, the industrials make a lot of sense, the XLI, and within the industrials, there's a huge group of industry groups. I'm looking at, the XLI has, I'm looking at my notes here, it has so many different industry groups into it. It has the aerospace and defense, it has building products, it has construction, it has all the transportation companies in it. So industrials has everything we need to keep our country churning away, from building houses to building airplanes to all the construction you can think of, the housing, and again, the transportation are all in the industrials, machinery of all kinds. Then we move into one of the biggest sectors, or one of the biggest sectors in the S&P 500, which is technology. That's the XLK, as you probably know. Technology takes up 27% right now of the S&P 500. So technology is one of the biggest sectors. And of course, we can break that down to all kinds of industry groups like semiconductors, like software, like cybersecurity firms. Also, does everybody know, or did you imagine that one of the top stocks in the XLK is AT&T and Verizon? This is where the telecom stocks are, and some people don't realize that. So that kind of helps you get a bigger picture and maybe a more well-defined picture of the cyclical sectors. But when the country is really booming, these are the ones that benefit the most. Now, I am not going to tell you, of course, that the rest of these lag during the markets move up, because they don't, but they don't get as much attention, some of them, because when tech stocks are going higher, there's nothing more fun than hanging on for dear life to NVIDIA or Netflix or Google when it's moving higher, or Amazon moving higher. That's the most fun of anything. And that's where traders want to be. They say, no, no, you're not putting me in consumer staples. I don't care about Johnson & Johnson when Netflix is flying. So the non-cyclical stocks or sectors and industry groups, but they're very much unloved a lot of times in markets that move higher. But boy, they sure get loved up a lot when the market starts moving lower, because then you want to go into a group like consumer staples, which is food and drug and beverages and tobacco, household products, things we have to have, like Walmart, Procter & Gamble, Coca-Cola, and yes, the tobacco companies. Now, financials can be in either place here, the XLF, and I don't want to spend much more time on this because time's limited. The financials are really the backbone of our economy. If the financials aren't going up, then we're kind of in trouble. And that would be JP Morgan Chase, Wells Fargo, those kinds of companies, of course, are in the XLF financials. It can be in either place. The financials can. It can be either cyclical or non-cyclical. They can do very well. Now, healthcare has been rocky lately, as you know, but guess what? Within the healthcare sector, there is pharmaceuticals, there's biotechs, there's medical equipment, and healthcare providers. And medical equipment has flown this year. So within the different parts of healthcare, if you just look at the XLV, which we're going to do, you say, well, maybe that's not doing so well. But if you dig into the industry groups, there's some real winners. You just have to know where to look. Now, everybody yawns. This one's the utilities ETF, the XLU. Everybody yawns. Please don't, because if this market starts down really hard for any reason, utilities are going to look very, very sweet. And there's a lot of utility companies that are mixed in with, kind of mixed in with energy. And if you look at utilities, you're going to see companies like Southern Company and Dominion and I'm trying to think, Duke Energy. In Tony's Market Club, we just got into Duke Energy, and it looks like a good bottom fishing play. We'll have to see how it turns out. But utilities can actually not be as boring as you think they are, especially if the market starts to look hairy. A lot of people dive into them. They are bond-like stocks, they're called. And their cousin real estate is also a place where people go to hide out. This is the XLRE, and this was put into the S&P 500, added to it about a year or two ago. And the XLRE has companies in it like Simon Property Group. They're the biggest malls, and you say, oh great, malls aren't doing too well, but they have malls that are doing very well. It's a popular company. So in real estate is AMT, American Tower, Public Storage, Crown Castle, Equity Residential. So it too, real estate and utilities, and we'll look at them, are kind of floundering right now for a lot of reasons, but if this market starts to roll over, and it's certainly moved up for a long, long time, these places, these utilities and real estate are going to look a lot better, and you're going to be following the money there. You might want to. Now let's look at a daily chart, a monthly chart of the S&P Spider. This is a great way, I love monthly charts, because then you get a really good picture of what's going on. So I really like them, and I flip into them many, many times. I told you that I think I did, that the markets of industrialized nations move in cycles. You can see on this monthly chart how exactly that happened. This is 1997 back here on the left side of the chart, and you can see how the market has moved in cycles from 1997. Then we had the bear market when we had the tech sell-off here. Then it came down 2002, 2003, made a little double bottom, started back up, made its highs right about, made a double top actually with the top in 2000. And then in 2007, if you were in the market, you probably remember this, it was pretty dramatic. We had a financial meltdown, and the SPY actually went below the low that it made in 2002, 2003. Then, of course, all the interest rates were lowered dramatically, and this is a 21-month average, by the way, moving average on this chart. And as you know, probably you know, the SPY, the S&P 500, except for a little dip in 2011 and 2015-16, it's been going up like crazy ever since. Now, what we want to look at right here on the hard right edge of the chart is the volatility. That the S&P 500 has undergone, as we know, literally almost from the beginning of the year. These big volatile spikes here, volatile meaning wide price swings, are really meant to be studied, because volatility can be a sign of a little trouble ahead, because the bears and bulls are arguing. And so this is something I'm keeping an eye on. When bulls and bears argue, the bulls push it higher, the bears push it lower. When they start arguing, you want to pay attention, because this is the point where things can change. They may not. The uptrend may continue, but also we may have more of a dip here and actually, you know what, it would be good. It would be good. Markets can't go up unless they go down a little bit. So that volatility is something we want to watch. Wide price swings can mark kind of a bit of turbulence for a while before we get back into our uptrend. Now, if we looked at this chart of the S&P 500 Spider, SPY, of course this S&P 500 looks like it. Look at this chart. Look at the beautiful move up it's made for the last 9+ years. Now, kind of look at that and memorize it. Look at the XLK. This is Select Sector Spider Technology ETF. Look how it has almost the same exact pattern, only it's moved up even higher. Now the XLK, of course, is made up of stocks like Apple and Microsoft, which take up 27% of the XLK, and then you've got Facebook, Alphabet, Intel, Verizon, AT&T, 72 holdings in it. So you can see how it's gotten, along with the S&P, since techs have really led the way on this bull market. You can only go up for so long, and anybody here in the room who's a runner knows that you got to stop for a water and rest sometimes, and that's what the market is doing right now. It's overextended, and as we see on the 14-month RSI, Relative Strength Index, that I highlighted here, we are in an overbought, excuse me, we're in an overbought position, meaning that the S&P 500, or the XLK, the technology stocks, and the S&P was too, are overbought. It's the RSI has moved over the 70 line. So it's like everybody is long the market. What happens if somebody starts selling? I'm not telling you any of this to scare you. That's not the point. The point is to be wise and to be safe. So now let's drill down a little. Let's look at a daily chart of the Select Sector Spider Technology ETF, the XLK, which has been such a leader. This is a daily chart. And all of that volatility, those candles that we saw, the candles that we saw that were so volatile on the top of the move, right where we are now, this is how they were formed from this pattern here. So you say, wow, Toni, well, if technology can keep going, can it keep going from here? And we'll find out as we get through earnings season. Can the Facebooks and the Microsofts and the Apples of the world, can they produce such incredible earnings that, and are their price to earnings ratio low enough that we can justify paying higher and higher prices for the XLK? Can they do that? And if the answer is yes, then we're good to go. And the answer is going to be on this chart. So, and it's going to play out in the next 2 or 3 weeks. So this is a real important time, and it's good to watch and keep an eye on the monthly chart, because it gives you a snap picture and a heartbeat. Is this volatility going to turn into something that can actually smooth out and go higher, or is it going to roll over a little bit? And if it rolls over, can you switch your mindset? Can you get flexible and be ready? And that's what we're all about today. So as we say, well, you know what if? We can always handle the good news. We can always buy back NVIDIA. We can always buy back Apple if we've sold it. We can always buy back Amazon. That's not a problem. We all know how to do that. But just say that the market starts moving a little lower. Then the non-cyclical sectors like healthcare, do you think that they might move into the spotlight a little more? Now, this is the Healthcare Select Sector Spider Fund, symbol XLV, and you can see that it certainly doesn't look like the XLK. It did ride up here pretty dramatically in December. Then it topped out with this gravestone doji and fell like a stone starting January, and then has been kind of racked around here back and forth, fell way below its 200-day moving average in the last bout of volatility, and finally ground its way up to over the 200-day moving average. Now, I look at healthcare again. I don't just see the healthcare sector. I see the industry groups in it. And the industry groups in it are like biotechs, pharmaceuticals, healthcare equipment, and providers. So let's look real quick. We got a couple of minutes here. This is a daily chart of the SPDR S&P BIOTECH ETF. Now, I'm not recommending that you buy it right now, but I am going to start watching it. Biotechs move on their own, pretty much on their own volition according to clinical trials, and they don't follow the market so much. You do have to remember that most biotechs are NASDAQ stocks, so they do tend to kind of follow the NASDAQ around a little bit. We can see that a double top actually happened here, and the XBI sold off, but then it did a throwback rally that we're in right now, and it moved right back up into this resistance zone. So what I'm looking at, and by the way, on this chart, the red line's the 20-day moving average, the green line's the 50-day, and the black line's the 200. I'm looking at biotech. I would like it to pull back here again, and then I want to see that this throwback rally has legs. And if it stays above the 200-day moving average as we go through earnings season, I'm not into buying it right now, but if it stays above the 200-day moving average and then bounces up from there, it might be something worth looking at if it looks like the broader market's going to fall. Now, also, I have a chart here, is what if you're getting more defensive? What if the market moves over a little more? Note how this is the Utilities Select Sector SPDR ETF. Note how dramatically it's fallen, mainly because the Fed's raising interest rates, and utilities are bond-like stocks that people buy when they want to get more interest or higher dividends, higher yields. Utilities, and besides, with tech going so crazy, people don't care about utilities. They're boring next to technology and some of the other sectors like that move much more quickly. So utilities have really crashed here. What does that mean? It means if the market rolls over, if the techs and the S&P 500, then some of the industrials, if they roll over a little bit and have to take a breather, especially because we've got May coming along, and you know it's the old leave in May and stay away thing. When people get defensive, they go into utilities. And this chart here shows that we may have a bottoming process going on. And as I told you, Duke Energy is in the utilities and the market club. Now, whether it's going to stay up or not, I can't guarantee. But we did just get into DUK. Now, if the market continues higher, utilities will have a rough time. If the market starts lower, utilities may break out of this downtrend that they've been in. And they're a nice place. I call them summer stocks because you can put on a couple of utility stocks, get a dividend, put your stops in, go to the beach, and it's a nice, they're summer stocks. They're not worrisome like some other big tech stocks are. So this is the utilities ETF if you want to get more defensive, and you can also look at real estate. XLRE is the real estate symbol. Now, finally, we'll look at energy real quick before we go. This is the Energy Select Sector Spider ETF, the XLE. And as you probably know, if you've been sitting staring at your screen all day like Ken and I do, you probably know that the price of oil has climbed dramatically, probably a lot of it on the back of Syria. But the inventories have been coming in lower than they thought. So oil's been moving up. So the energy stocks like, well, you know, so many of them, Exxon, Schlumberger, Halliburton, that whole group have really flown. Would I buy it here? No, I wouldn't. The XLE has moved up dramatically. I would wait for a pullback. Hope if it moves all the way back down, I will not be happy. But if it moves halfway back down the last run, maybe down to 71 or so, and then bounces, you know, definitely you can add a position at this point if you don't have any energy stocks already. So energy may be a place that you want to be. Again, as a trader, I would wait for a pullback here. Now, I meant to write this down and I didn't for you. If you want to look at a whole list of sectors and industry groups, and also sectors with stocks in them, with their top stocks, go to ToniTurner.com, look at the top bar, the top toolbar, look for the education tab, click on education, and you'll see 2 pages there. You'll see sectors and stocks. That's the 10 select sectors, and there are 5 top stocks in each one. So you've got a place to start with a watch list in those groups and in those sectors. You can also look for a page that says sector ETFs, and it gives you a whole list of the select sector spiders and also a big list of industry groups. And they will give you a little extra twist on the bigger sector. So that is really, really helpful. Now, so please do that. It will help you. With that, I'm going to get ready to close here. I just do want to say that if you'd like my free newsletter, you'd get it in your inbox on Saturday mornings. It talks about the market. It's called The Market Now. It talks about what the market's been doing this week, where I think it's going next, and it also gives you an ETF that I think might be ripe for a high potential trade. So that is in my free newsletter, The Market Now, and you can get it at this link right here, or you can sign up for it on my homepage. It's easy enough to see, and again, you can contact us at ToniTurner.com. Finally, I did want to give you guys something special, an opportunity to join us. We rarely ever discount Tony's Market Club because the price is already so low. But for Ken's people today, I am offering Toni's Market Club the first month at $20 off. It's already a very low price, and you see the coupon there is 77TMC for Toni's Market Club. In Toni's Market Club, it's about an hour and a half. First of all, we start with market insights, where which side of the market we want to be on. We have a mini trading lesson. I show you some strategies you can use when you're trading. I give you 5 stock and ETF picks. That's 3 long, 2 short, plus something we call a Vegas trade, which means I like the pattern. I didn't research the fundamentals, because I go in and research the fundamentals for you. So that's kind of a luxury, I think, for a lot of people. The price is already very low. There's no contract, nothing like that. You can join or leave whenever you want. If you'd like $20 off the first month and you'd like to try it, the coupon code is 77TMC, and you can use that at tonysmarketclub.com, which explains everything you need to know. So Ken, I think I did it. I think it's 5:30, and I would like to turn everyone over to you. Thank you so much for inviting me, and thank you all so much for being here.
Well, thanks so much, Toni Turner. Exceptionally professional, intelligent, well thought out presentation. I picked up tips myself. I was taking notes on the differences between some of the sectors and industry groups in the XLK. So really well done. I highly recommend Toni Turner. Get her books, join her market club. She's one of the smartest people I know in the trading industry, and definitely one of the sharp pencils in the bunch, and a good person to learn from. So thank you very much, Toni, for being here.
You're welcome.
Okay, well, welcome aboard and welcome back, traders. We're going to be looking at some of the strongest recent charts. For example, in today, our oil ETNs and ETFs. My favorite pattern is gap continuations. And we're going to be looking at some of the strongest breakout ETFs and ETNs, such as the oil sector. The energy was also strong. The energy bull triple ERX was up nicely today as well. When we look for patterns to trade, one of the very first things we want to look for is, I always teach traders to trade markets first and the individual ETFs and ETNs second. And we're going to be looking at a strategy for that. Let me go through a couple of quick PowerPoint slides. It'll take less than 3 minutes, I promise. Then we'll jump back into the charts. I'm Ken Calhoun. You may have seen the sadly now defunct Active Trader magazine. I have a monthly Trading on Momentum column in stocks and commodities. I've been a money show speaker for 15 years. It's been great seeing, and again, it was really nice to be voted to the top articles for last year in the Reader's Choice for Stocks and Commodities magazine. So I'm an author and a speaker. And importantly, I'm a real trader too. Here's P&L proof for my Interactive Brokers account. I did $4.9 million worth of trades, made a little bit, made about $1,000 plus a month in profits on that, and tax return proof that I really trade. Brings me to a quick tip. When it comes to becoming a better trader, it's important that you practice and paper trade and sim trade a lot, more than you may be initially comfortable with. You know, one of the things that helped me become a successful trader was to do a lot of trading. Now, not to say I have to do 5 million worth of trades in a single year. That was a year of a lot of coffee. Caffeine is a trader's best friend, but I do encourage you to test and experiment. Today, we're going to look at the best ETF setup, strongest day in swing trading charts, risk management, and scaling. And I'm almost done with the PowerPoints, I promise. We're going to look at minor gap continuations, multi-day high breakout charts, and entries following what I call wide candle days, or days that have exceptionally strong volatility and breakout strength. So let's start off with their S&P. Here's a 90-day daily spiders chart. One of the first strategies that I wanted to teach you is look for what things are doing with the S&P ETF, the SPY, relative to major moving averages. Now, every trader uses slightly different moving averages. I use the 50, the 100, and the 200 simple moving average. The main one is the 200 SMA. They get progressively less signal strength important with the tighter periodicity. But the point is, what does the pattern do between the 200 and the nearest 100 SMA? We finally took out new highs in yesterday's market, so that's important. We've been in an uptrend for the last week or so, and one of the quick tips is stay how to say, don't trade, or at least I don't trade index tied ETFs like the spiders as long as they're range bound inside the moving average line. But I look for new breakouts. So if you look at, say, the 15-minute candlestick chart in the spiders, you can see we've got a bullish cut breakout, a minor gap continuation from yesterday, which is all well and fine. And we're finally starting to break above resistance. But, there's always a but. What has this market done the last month and a half? As one of my traders, Mukesh, wisely said, it's been on a roller coaster the last 6 weeks or so. And so every time it's sold down, it's gotten new buyers, and it's sold down and got buyers, and sold down and got buyers. Drives one nuts. And again, this is where experienced traders tend to do better than the less experienced traders, because you don't want to be a trend following person. You want to trade breakouts on new strengths. So anyway, what I'm saying to you is, it wouldn't be surprising at all to see the S&P collapse back down into the previous trading range. So from an ETF standpoint, pay attention. The rider downer is, pay attention on the spiders 90-day daily chart in terms of what the trend is doing and what it's doing relative to the movement between the 200 and the 100 simple moving average. Those are institutional lines, and that's what professional traders use. And so it's all systems go if we are able to hold and stay above the 100 SMA. But if it drops back down, it'll be back down into a chop zone as it's normally been. Now, when it comes to recent strength, one of the things that you can notice is we've had really good strength in the oil sector, ETFs and ETNs. And I'm long this right now, just a disclaimer. I'm long UCO and I'm long USO as well. And these are instruments that go up in sympathy with oil sector. One of the things I like best about ETFs is the minimal risk in terms of gaps. There's never any huge gaps in any of the ETFs. They're characterized by small gaps, which are my favorite chart pattern. That's one big strategic advantage to trading ETFs over their component sectors or their component individual stocks is if you get an earnings miss, it's going to put a big dent in the stock price and it's going to gap down many points. The ETFs are relatively safer because they have small gaps, which are much safer from a risk management standpoint. That's the biggest single advantage, kind of like with Forex. You got the Sunday gap, but that's it. It's kind of a continuous line. When you're looking for great breakout patterns, always be on the lookout for small gaps that continue. Here is USO. It's our US Oil Fund ETN. Small gap here, another gap here, another gap there. Gaps usually trend or continue in trend. So you're looking at these on a 15-day chart, one of the things you want to look for is continuity. And Toni had mentioned too about industry groups and sectors. And so things are looking good in the oil, and the world of oil is looking really good. Here's our Van Vector's Oil Services ETF, OIH, oil holders. And again, you can see a small gap that continued to trend, and yet another gap that continued. One of the things that I like and one of the reasons I'm long these instruments is the huge upside potential. If you look at, say, a 5-year in the USO, it's been in an uptrend for quite a long time. We've got a hammer here, we've got some bullish lower shadow here, we've got a uptrend here. One of the things visually to look for, and again, I've traded millions of dollars worth of stocks and ETFs. I know how to trade. A quick rider downer is look at the ratio of green to red candles and give preference to those charts that have 70-80% or more dominant green candles. It's a quick visual technical signal if you're looking for pivot plays especially. Now the exit target for a chart like this is you're not going to likely get the entire range. You usually get, you may have seen my articles in Stocks and Commodities on mean reversion swing trading and intraday trading. The exit target is likely going to be 50% of that range. So often when I'm doing a bounce trade, we get in long, I'll scale in again if it breaks over this moving average, but my exit target, I'm happy as a clam to buy in at 11, 12, 15, 17, and sell it all at 24, 25 for a 50% run. It's likely to stall and drop out off that. Then I can always rebuy if it climbs above this moving average line. So if you're playing mean reversion or pivot plays, look for the strongest charts, and that's a couple of signals. So one is ratio of green to red candles. Give preference to charts that have 70-80% recent green candles on whatever interval, whether you're doing day trades or swing trades or position trades, and look for a sensible, well thought out trading strategy that makes sense. Look at this guy, UCO. What a range. This one has much more leverage. Look at this. We had a bearish engulfment up here, way at 400. Now it's on sale for the low price of just 20. Well, usually it's a bad idea to try and catch a falling knife or a dead cat bounce. Ouch! Stop outlaws. But stop the madness. There's got to be a better way. We've got lots of green candles here lately. This may be good for quite a big run up here as well. So this is a play to trade the recovery in oil that we've seen. And this is our ProShares Ultra Bloomberg Crude ETF. So lots of ways to play the sectors. Now, one of the good kind of, how to say, professional trading approaches when markets are weak and uncertain and they don't know what the heck they want to do. I mean, recent buyers in the spiders, but for the longest time it's been kind of choppy. Isolate those industry groups and those sector specific stocks. You know, what's going on in sectors that are doing better than the broad market, and always look for relative strength. Now we have a shooting star here in the XME, but this is a metals and mining ETF. The metal stocks like US Steel X and others have been strong lately, and the metals ETF has also been strong. So energy, oil, and metals have all been strong lately. Now when you see a chart like this, and you have, say, a shooting star, which that is, one does not buy right now. One waits until we take out new highs, if and when it does. So it ran up here. This is a 2-day chart. This is a day trader's chart. A nice open range breakout, pullback, small uptrend, a gap continuation. It's doing kind of a rollover here. What one never does is buy right at the new high. That's the dumb money entry. I should know because I used to do that thousands of times the wrong way, blowing up a couple of trading accounts. Never buy right above resistance, because how many of you have ever been caught by a false breakout? We probably all have. You get in because it's breaking to a new high only to see it then go down. You get stopped out, and then it runs up like 5 points without you. So let me ask you, how many of you, show of hands, have been directionally correct in a trade? Eventually it did go up, but not before you got shaken out or you got stopped out. Whenever I ask this at Money Show, all the hands go up, and it's one of those very common misfortunes as a trader. The strategy that I use lots of times. Thanks, Deanna. A lot, Tim. Hey, one of the things you do is put a false breakout filter, say 50 cents, minimum 30 cents, 30 to 50 cents above the high. The earliest I would buy this guy, this XME, would be over, say, 37.80. Conservative entry would be somewhere north of 38. And again, we're going to run it over at resistance near the 39. So cautious, but it's been on an uptick ever since. So one of the things to look for is how to isolate. How do you figure out what is doing better than the broad market? Well, just visually scan. You look at the spiders chart. You don't have to have all these ETFs, but do be on the lookout for charts that have a sharper slope of a line that are beating the market, and give preference to those industry groups or those sector charts. So that's a whole heck of a lot healthier than this SPY chart, right? Because it's at a 90-day high. This is UCO. Our energy bull triple here, you can see, is also done nicely. Now I wouldn't go in long. I don't want to chase because it's already been going up so long, and we got almost a shooting star, bearish upper shadow, at least up here. So I'd be cautious on this one. It's still on the radar, but I think like Toni mentioned too, we'd want to see a pullback and then a continuation. You don't want to just chase something and hope that it keeps running, because that story ends badly. To quote a family member, that ends badly. So you don't want a chart that does badly. You want to find these charts that have good exceptional relative strength. So oil sector is hot. Who else is strong? Gold is strong. If we look at, for example, GDX. I've traded GDX for many a year, and it's been on the uptick too. And that's unusual. Usually gold is inverse to the stock market, but in this case, GDX is up. And if you look at our Nuggets, another one that's been up, and JNUG. Now, when I trade these, what I will often do to help minimize false breakouts, or actually a better phrase is to hedge my bets, is I'll trade all three instead of just picking one. My favorite's been GDX for years, but instead of just say picking one and doing, say, 300 shares GDX, I might do 100 shares in GDX over, say, not a trade recommendation, but where I'm going to trade it, say 23.6. Or if I buy JNUG, the junior gold miners, I may go another 100 shares, say over 17. Again, 50 cents above this moving average line. This is an exit target, by the way. If you're playing a bounce, the 200 SMA is going to be your initial exit target. So mission accomplished. Professional traders are selling here, which is why we have a kind of a gravestone doji, almost gravestone doji pattern here too. We got a bearish upper shadow because we're at the 200 SMA. So you can always rebuy new highs. You can always get back in. Any good professional trader will tell you that. Your thought process as an intelligent trader is, what's a price that's going to act like a magnet to draw in a bunch of new money? Always follow the money. Wall Street loves money. Money is like water, and it has to find a home, but not without some chop and churn. So here would be a danger zone, and you can use this for any type of swing trading you do. I like to use as published in stocks and commodities. I've usually found as a general rule of thumb, 50 cents above a high is usually a good false breakout filter. If it's gonna stop me out, it's likely if I buy, say, 16 and a half, 1660, then it rolls down to 15, I get stopped out, then it runs up to 20 without me, and that's frustrating. So instead, add 50 cents or so to the obvious public dumb money area and sidestep it, because market makers are sharks, and specialists or sharks are going to step on the bid, or they step on the ask rather. They're going to hold the ask, drive price back down at the obvious breakout triggers. So this falls in the category of how to avoid false breakouts in these pesky instruments if they don't run. So again, spiders are doing that, but the oil sector instruments are sharper in an uptrend. And what's a hedge? A hedge you can do. If the stock market sells off, one thing that I always trade is the VIX ETNs. During the first big crash during the first part of February, this guy ran from 28 to 58. Now these are for sophisticated traders only, and they're not for new traders. But the VIX ETNs like VXX and UVXY have especially good volatility, and they're not for newer traders, and they are dangerous and leveraged and all the rest of it. But if the stock market sells off, this goes up. So it's just something to be aware of. It's been going down because the S&P has been going up. Every time the market crashes, this guy goes up, and it went from 40 all the way up to 53. Now recently it's gone back down to 40. Do you see a pattern? We're at support. Our technical support line, and this is exactly 39. So if it loses 39, watch out below. The market will likely rally, and this can keep on going down. This is a VIX ETN. This is the iPath S&P 500 VIX. But if the stock market starts to sell off, I always go long in the VIX ETFs. I also trade other inverse ETFs, like QID and SDS. There's a whole bunch of them out there. Be aware of it. You may want to Google inverse ETFs. These are three of my favorite, though, that I've traded for years: QID and SDS. There's a lot of them out there. There's TWM, it's the ultra short Russell. Be aware of instruments that go contrary to the stock market. And that's one way to play long with the stock market crashes and burns, is be aware of these things. Or like the SPSX is another way to go long. So this is the exact polar opposite chart of the S&P, the spiders chart, right? The spiders looks like that. The SPXS looks like that. So my plan for the upcoming, I don't know how many of you agree with me that the stock market is very well possible going to have a big crash and burn sometime this year. If it does sell off sharply, be aware of the inverse ETFs and have a trading plan designed to capitalize on that. And there's a whole bunch of them, so narrow the field of focus. Like I said, my favorites are QID and SDS. And DXD is another one I've traded for years. That's the Dow short. And it's lower price, but lower volatility. So be aware of those. Be aware of market dynamics, the charts that go up when the stock market goes down, and vice versa. And then also isolate those sector-specific ETFs like JNUG, the gold instruments, JNUG, Nugget, and GDX. And GDX is my favorite gold instrument, and then the oil instruments as well. Okay, so another quick tip is be aware of arbitrage opportunities in instruments that are opposites. Just like the stock market ones I just taught you about, FAS versus FAZ. When one goes up, the other goes down. FAS is our finance bull triple. FAZ is the finance bear triple, and they move in opposite directions. And so there's a lot of ways that you can play the ETFs. And one of the things that you want to do is be aware of which ones have best relative strength. Now, the ETFs as a group have not been especially strong during this last month and a half that the stock market's been kind of volatile sideways. What you want to do is look for emerging trends. So here's like our energy ETF, the XLE. And again, this guy broke above all three moving average lines, which is a bullish sign. It's ran up, it's got a bearish upper shadow, maybe worth a shot up at new highs. But do be aware of things that are tailing up like this, and be aware of, like I say, the ratio of green to red candles. Another quick kind of a poker tell. I won my first poker tournament in Vegas at the Luxor about 7 years ago. I don't have time to go to Vegas and play Hold'em anymore, but one of the poker tells for professional entries is look for large green candles. This is what I mentioned in one of my PowerPoint slides. You got large whole row body green candles, especially if it breaks a major moving average on high volume. So volume confirmation. Do pay attention to volume, and always give preference. Traders vote with volume, and we capitalize on volatility. So do be aware of increasing volume, and this is a pattern that I've published on in stocks and commodities too. You got a large green candle with confirming. See, this is multi-week high volume. See, this volume here on April 10th was, over a month. I guess the previous high was way back here in March 1st. It's been over a month high long volume with a large green candle. The buy signals add 50 cents to the high of that signal candle is what I call these. And again, this is a gapper too. It's a gap large green candle. You add 50 cents to the high, and that gives you your entry trigger. In terms of the mechanics of the trades, I trade these guys in multiple accounts, mainly my Fidelity SEPARA, but use buy stop limit orders. So for example, if I were to buy this guy, I'd be skeptical here, but I may touch it if it breaks 75. I use the buy stop 75, limit 75.50. And that's to specify the window within which you want to enter your position. Or let's say you're looking at one of the oil instruments, like UCO. Remember, we add 50 cents to the nearest whole number high. So my scale in, I'm going to add to my UCO holdings if it breaks north of 31.50. So I put a buy stop, again, not a trade recommendation, but at least how I manage my order flow. I put a buy stop 31.50, limit 32, order in. So if it breaks above 31.50 and trends between that and 32 during a given day, I'll add to the trade. Now you notice, please, here we've got a gap continuation, and these are my favorite patterns. You always look for these small gaps that continue. That's kind of the poker tell that buyers are in the house. Small gaps that keep going up, especially if you've got a high volume close in HVC, will often lead to another additional gap, a sequential gap. So we've got a large, this isn't especially high volume on the close. So that's not a high volume close, but it's a high price close, which is the next best thing. Or actually it's better, it'd be best if we had both high volume and high price. But anyway, the point is, got a gap continuation in UCO, so that's a good bullish pattern. May want to look for a breakout north of 31, say tomorrow or the next day. Or with USO, you can see same exact chart. Oh, and by the way, that's another great advantage of the ETFs. So I love these guys so much. ETFs, you can pick your poison, pick the price point at which you want to engage with the given industry group or sector chart and trade it. So you get the same exact chart. UC looks like that at 30 bucks a share. USO looks like this at 13 a share. Now you get less leverage and less volatility and less profit potential in the cheaper instruments, but if you're capital limited, you can choose your poison, or choose the price point that fits your own personal trading needs the best. And that's one of the huge strategic advantages of trading ETFs. The trick is you got to know which guys are part of the same industry group. And the same thing, like I said, with gold. If you want to engage with gold, you can play GDX at 23 bucks a share, or JNUG, the junior one, at 16 a share, or NUGT at 28 a share. All pretty much identical chart patterns. So that gives you flexibility as a professional trader for swing trading. You can choose the price point that makes most sense for you. And what I say, one thing that, having done quite a few million worth of trades, is it always helps to diversify and play the field. It's so much smarter. This is lessons learned, honest lessons learned the hard way, is that it's so much smarter as a trader to trade what I call trade wide, not deep. Or I've got a colleague, Tom Sosnoff from Tasty Trade, who says trade small, trade often. It's exactly the correct thinking. You want to look for entries. What I like to do is I will play the field. It's so much smarter to trade 10 100 share trades than compared to one 1,000 share trade or two 500 share trades. Even if the capital allocation would be the same, It's much smarter to spread your risk and diversify like a portfolio manager. You want to diversify your risk and trade a number of different instruments with small initial size and scale in or position size. And again, on ETFs in the $20 to $50 share range, I will scale in every 2 points. So if I buy 31.50, I might buy again at 33.50. But I start the party off real small so that if it goes against me, which, by the way, over half your trades are going to go against you. How do you make money as a trader? What I call a 30% rule. I'm even more skeptical and pessimistic. I'm a former corporate statistician for the Ford Motor Company, and I'm a hardcore numbers guy. I miss Ford. It was a great company in Dearborn. I don't miss the Michigan winters, but the people there are great. But the point is, it's a lot more about the math than the chart patterns. That's another quote. One of my quotes that you can quote me on. Trading successfully is a lot more about the math than the chart patterns. So how do you make money if you're only right a third of the time and 2/3 of your trades go sideways or blow up? Welcome to my world. Professional trading is not about getting 51% plus of your trades right. It's about managing the back end of your trades with the P&L more correctly. So even if, and I used to show screen cap real money trades of how I still made a lot of money being right only 30% of the time. As you might expect, the stop losses are really, really tiny. And the wins are moderately bigger because I position sized or scaled into them. And again, position sizing, you may scale every 2, 3, 4 days or so. The whole round trip of say 2 or 3 position sized trades may last up to several weeks or even a month or two. Or some of the longer term instruments like oil, I'm trading as position trades for 8 months, a year or so, because I want to see how much I can make out of these, because the leverage is outstanding. Like I say, the greed gland should be a running, right? Ka-ching! Even if it only goes back half, quadruple your money, right? This is UCO, right? USO doesn't have quite the same leverage, but it's still a really good play if it continues on up. So, I wouldn't expect it to regain 400. I mean, I'll be happy if it goes from 40 to 400. I'll be doing cartwheels, but hey, I'm happy realistically to double my money if it goes in, say, if I scale up during 40 and sell under the moving average line or 80, then I rebuy over 80 and they'll split it, so it'll be cheaper. But the split adjusted price over 80 and scale in with an exit target around 50% of the trading range. That is a strategic bounce play in oil. So those types of charts make a lot of sense, especially when you put it in context of what's been going on lately and try and isolate the strongest charts in a way that makes sense for you. So I hope that between Toni and myself, we've given you ample food for thought as traders. Let me wrap up by giving you some mental thought process here is putting it all together, your personal trading action plan. What entry patterns are you going to trade? How do you set up your stops, targets, and exit signals? Have a personal ETF trading plan and take action. I wanted to invite you to my free #1 in the whole trading industry that I've seen. We just broke the 5,000 mark 2 weeks ago. I've got over 5,000 people who have registered for these every Saturday at 10 o'clock for a quick 20, mercifully even briefer than this presentation, 20 minutes. I go over the market, key support and resistance levels in the S&P, a few hard charts. I update you what's going on in oil and gold, and we have a lot of fun. So you can see my face that shows too. I do the webcam live, so you can even see my smiling face if you wish to see that. And so you can get there by going to trademastery.com free, or if you go to my website at trademastery.com, the link is right here on free trading webinars or trading week ahead. Okay, and you can also get my free trading ebook. It's only like 20 pages. I just got my top 5 chart patterns and a couple dozen notes. So it's not one of those epic, takes forever to read. It's a quick, 5-minute read, and you can get that free. I originally sold this guy on Amazon, but it's yours free at trademastery.com. You can register for that. If you're a swing trader, you can try out my swing scan service. This is my #1 swing scans. You can get free now for the low price of just $7. And other weekly webinars from 10 to 11, and we go over my top 10 charts for swing trades, and you can see much more information and a really good, a lot of work to put a nice video that tells you all about it, and that's at swingscans.com. So I'm Ken Calhoun. I wanted to thank all of you all for being here. Toni Turner, absolutely one of the top professionals to learn from. I've learned a lot personally from Toni. She's really smart and a credible top industry expert. So learn from Toni. She's one of the good people out there. I hope that this has been instructional and that you guys do great. Wanted to wish you the best for successful trading ahead. And apologize we didn't have time to answer questions because we have so many of you here today. We had, I don't know, something like 500 registered, a lot of people. So anyway, thanks so much for being here. We will get the replay video out to you later. Look for a link in a GoToWebinar email that'll be sent to you in a few hours. It'll have a downloadable link of today's presentation as well as a YouTube streaming video link as well. So thanks everybody, and thanks for the kind words. We get a lot of thank yous coming in. So best wishes for trading success. Trade smart, trade with passion, trade intelligently, and let's go get them. Take care and do well in your trades, and we'll see you next time. Bye everybody.